kind of move back into, we kind of got away from that income to debt ratio. So explain income to debt.
Yeah. So this is the
third
final
pillar.
right?
Yeah, this is the big one for a lot of people, because they ask, what home, what can I qualify for? And I think a lot of people, when they get that first number back of what they can qualify for, it's a little shocking.
Yeah.
In the opposite direction that you would think. I mean, a lot of times you qualify for probably much bigger mortgage than I think even a lot of people would be comfortable qualifying for.
For sure.
Because then you start to break down that monthly payment, and you look at that, and it's a little crazy.
Yeah.
I know when I bought my first home, for $150 5-6 years ago now, and I think I qualified for $250 at the time. And of course, this was 3 years out of college, and I was looking at that going, wait, you want me to spend $2,200 a month? No, that's crazy. Where? What money are you talking about?
It's crazy.
Yeah, it's nuts. But I always advise my clients, get pre-qualified, obviously, before you start the process, just so we know what kind of homes you can be looking for. Do you talk with your clients about maybe not looking up to the peak threshold of what they qualify for? And then kind of talk about loan to debts, what that looks like, what you guys look at to factor into what they can qualify for.
Yeah, absolutely a discussion that we have. And that's probably, especially with first-time home buyers and, our millennials, millennial friends that are buying and things like that, it's going to be really based off of, there's two numbers. There's what does the government say I can qualify for? What's the max number? That's exciting. Frame that, put it on Facebook. Yeah, I could buy a $600,000 house. I'll eat ramen noodles, and I'll never be able to turn my electricity on.
Yeah, and I'll sit on a yoga mat in the
sounds great.
living room.
Yeah. Or back to reality, back to my budget. Okay, maybe my budget is a $300,000 house or $250,000 house, whatever that is, right? So those are two separate conversations. And I always start with what's the max you can qualify for to put that as a baseline. And what I've found is just like you said. I mean, most people are shocked at how much they can purchase. Some people don't have good expectations and they have hurdles with income, and that's something that I'll coach them through too. But a good ballpark number. So don't quote me on this. This is a ballpark number. Okay, if you take your income before taxes divided by 2. Okay. That's typically what all of your debt can equal.
Do you guys have pen and paper out right now? You're writing this down?
Yeah,
Divided
quoting
by 2.
per Shane. Shane says, so write me a pre-qual. So if you take your income before taxes, so let's say you make $50,000 a year, right? So let's get out our calculator together here. So if I make $50,000 per year and comes out to a total of $4,100 per month. So $4,160 per month, right? So if I divide that by 2, all of my debt cannot exceed about $2,000 per month.
Okay.
So I have $50,000 salary, then that's about $2,000 per month is a max amount of all my total debts.
Okay, and what debts do you guys factor? Are you looking at my utility bill? Are you looking at what I spent at the bars last month? What factors into that debt for that $2,000 a month for somebody making $50,000?
So you're safe at the bars. We won't have to look at. Yeah, you're good there.
Don't cut into my bar fund.
It's just going to be anything basically that shows up on the credit report, which is going to be student loans, credit cards, or what we call installment debt. So any installment debt is going to be anything that car loans, if you have any kind of basically loans with a balance, furniture loans or things like that.
Okay.
Anything you have a balance on that you make a set amount every month until it's paid off.
Second mortgages if you have a rental property.
Yeah, anything like that.
Okay.
So any of those, any utilities, cost of living, anything like that. Remember we said the actual number is 45%, just for the record. 45% is the max debt to income ratio.
Debt to income, okay.
Y'all are ballparking this, we'll say 50%.
Yeah,
easier math,
makes
right?
it easier math.
So the other 50% or 55% is going to go towards cost of living, taxes, utilities, the bar bills, other stuff that you guys do to cover that. And then they figure the rest is to go towards those, basically anyone that's going to come knock on the door and tell you, hey, you owe us money.
Okay.
Yeah.
Now let's dive a little bit deeper. I know we're talking first-time home buyers for the most part, but this kind of spurred my interest. So I have a rental property down in school that I went to. It's currently being rented out. How much of that rental income can I apply towards that debt if I were to go get qualified for another loan? what does that look like?
Yeah. Paraphrasing guidelines here. That's it. That's a little bit more of an in-depth question.
Ballpark again.
Ballpark, typically you can actually completely cancel out the debt per qualifying purposes.
Okay, so as long as my mortgage is being covered by my rental income, you can cancel that out.
A lot of the time.
Most
yes.
of the time in most situations. Okay.
I'm giving Nash the evil eye for putting him on the spot. But yeah, a lot of times with my investors that I work with, we're able to structure it to where if you have a $1,000 mortgage on a property and you have $1,200 of rental income, it's pretty much going to cancel out as if you don't have a mortgage there. Which is pretty exciting because it used to be where you had to put that in.
It was like 75%. Where they
75%, then add to go your income, so
yeah.
50% of that. So you're only basically covering like 50% or less of your rental. But pretty exciting, they're actually able to cover the full amount now. They changed the guideline on that.
Okay. So, I mean, a big question, obviously. Now we're going to get kind of back into more of the first-time home buyer. So a big question I had. I got asked this multiple times when I posed the question to Facebook was, how does student loan debt apply towards qualification? It sounds like it's just basically the same as credit card debt, or what your monthly credit card bill is going to be, or what your car payment's going to be. There's no difference between those, correct?
So, correct, yeah. It all comes out the same. So it goes off of what the minimum payment is on, like, minimum payment for credit cards. That's great that you bank $100 extra over payment, but it's just the minimum payment. Same with student loans. If your minimum payment is $100 a month, but you make $500 a month to pay it off faster, good for you. That's not going to hurt you. That's just we're just going to use what the minimum payment that's listed on the report or the student loan statements are.
Okay. And obviously, I mean, this is something I advise all clients. Again, I'm not a financial advisor, but common sense states, guys, get the student loans paid off. I mean, most of those, the ones I had were 8 to 9 to 10%, just crazy interest rates.
Yeah.
That would be my first. If you got to make double payments, what do you got to do? Get those out, because you're just burning money.
Agreed.
So I would say that's the first one you want to get off. Credit card debt, again, do what you can. Don't be carrying a huge credit card balance, because it's just not good. But so roughly what we're looking at here is 50% of your monthly take home prior to tax.